any questions straight away? I'll go to the back. I'll go to Charlie first and then Jay after that.
Model, the equity partnerships model in New Zealand, and just the query about why you think that it has taken off much more strongly in New Zealand than it has in, say, Australia. I know there's a lot of these models being promoted around the place, but we're not getting the same indication that the take-up is anywhere near as strong.
Yeah, good. I mean, it's a good question because I mean, it's not a model without flaw. I wouldn't want to paint it as a perfect model by any means. I mean, you need to find like-minded investors. You need, I think the governance requirements become much more important where you've got different investors compared to a family farm. I mean, one of the differences in New Zealand is there's no capital gains tax. So when you buy into these things, you can also sell out of them and essentially pay no capital gains tax. That may be a little bit more of an incentive, I guess, for investors that they can get in, they can sell their asset and get out, and essentially not have to pay capital gains tax. Whereas I think in Australia you've got to roll it over into another investment, otherwise you're going to pay that tax. But I don't think that's the primary reason. I just think farmers see it as an opportunity to expand into scale businesses without having to do it all on their own. The other thing is land values are quite high in New Zealand. I mean, dairy farms these days are trading at $40,000 to $60,000 a hectare, and you know, I just think the tasks of expanding on your own with your own equity, notwithstanding that New Zealand banks and Rabobank have reasonably high appetite for leverage, to expand into scale at those sort of land values is just beyond a lot of farmers. So what's the next best solution? Find your mates and put some money into an equity partnership. But I don't think that answers your question as to why it's worked there, but it certainly has taken off over a long period of time.
You did say $40,000 to $60,000 a hectare.
Yeah, 40 to 60,000. Yes.
Right. Marcelo, I'm interested in Brazil. My experience there were quite a reasonable population of young farmers. Are there any special measures there that help young farmers come in, or is there much separation of the land ownership from the operation of the farm business in Brazil that you're aware of?
Well, I think that as many other countries in the world, it's an aging process of our farmers in Brazil as well. We have, for small family farmers, we have a program called the Young Pronaf. That is our main program for family farming that intends to provide some incentives to keep farmers in the farm, not to let them leave the farms, so that they could count on some of additional incentives. However, it's separated from the ownership of the farmer, but in general is for the owner of the land, or sometimes the sharer. It's very common in Brazil, this kind of operation that is shared between the landowner and the worker, the farmer worker, but it's available for both. But I don't know if it's been succeeded, because we don't have much information on this, because I personally don't believe it's being very successful. So the process has been occurring, and despite of any governmental initiative.
Okay. I think Jay had a question there. Just straight in front of him.
Jay Horton, Strategis Partners. My question to Michael. This morning, David Sackett gave us a very good expose of corporate agriculture, warts and all, and perhaps it might be described as the first wave. In New York last month at the Global Ag Investing Conference, I think there were detections of a second wave, and a wave that's very much interested in Australia and New Zealand. Michael, would you like to comment on what you heard?
The National Press Club's slightly down that way, Jay. Feels like a press conference. Look, the observations, and I mentioned at the start of the presentation too, and it flowed on very well from David's presentation before, that the observations were that I think somebody in the first session raised the example, or Mick might have as well, of the very different model of American agriculture in terms of the lease versus directly owned as well. So what we have is we have American institutional capital that has over 6 years found itself comfortable with allocating a set of its alternative asset basket into agriculture. I think, was it once again David or Mick who talked about if we got 1% of this. What's quick mental arithmetic on that $3.5 trillion in that room? That's $30 billion odd dollars into global agriculture, and then allocate a reasonable proportion of that into Australia. And you still have a huge amount of that is now looking at Australia post the US as its first offshore dip into agriculture. And I can say from discussions around that room, you have some major American multinationals who are looking to allocate just a small, what's the drop in the bucket for them? And I'm going back to what David said again, but rather than 400 million, some of these are talking 1 to 2 billion. They're serious, but they are really saying we do not want to overpay, and we up front do not have the skills to manage this, and we've seen the other examples out there that were raised before. We know of the management capability, and we are doing our due diligence at the moment. The second point out of 3 to raise on that is we shouldn't get too confident. What was also interesting to see was that whilst the Ukraine events were happening around us, while last year at a similar ag investing event, in Singapore, a number of global investors had said, we're finding the Ukraine may be too difficult for our liking after going in there. In the space of a year, these same investors were saying we are now at a point that despite the Russian incursion, we are comfortable with the long-term progress of our investment and we are looking to upscale. So we really do have competition there with that flow of capital on the way through. And the third part to raise about what came out of New York was on day 4 of the presentations there. How do you manage to keep 600 to 800 of the world's main investment managers in a room to look not at agri-production or supply chain investment, but at ag venture capital into technology? And particularly technology, everything, whether from crop production, whether from seed technology, whether down the retail chain as well. And while we're in the process here in this country of discussing R&D and trying to allocate whose responsibility is and going through another ministerial white paper process, I think we need to be cognizant of the fact that so much of that investment is now looking at some of the R&D needs of countries like ours, looking to see how they can make a return on it and how we can tie into that. So that's some of the feedback that I brought back from that.
Okay, we've got a question in the middle. Yes.
Just a quick one, thank you, Mick, and probably to all speakers. Ben and Marcelo talked a lot in terms of debt financing, and to me the impression I got was that it was a consolidated effort. In Marcelo's case, consolidated effort on part of agriculture to seek debt financing in a very realistic way, and probably sector-wise, I think for you, Ben, in terms of the dairy industry and how they've worked together. Just your comments in moving forward, seeking capital investments into Australian agriculture. We haven't ever been very good at working in a consolidated fashion, and I think individuals work particularly well to get their debt finance and negotiate debt finance, depending where they sit in the whole scheme of profitability. How do you see going forward? Should we as an agricultural sector looking for investment, should we be working more consolidatedly, if that's a word, or as individuals, making a sort of a play for our profitability as individual companies?
Yeah, it's a good question. I think, and I'll give a typical answer, it depends. In some ways, for those family farms and who've got good equity, who've got good scale, and have got the capacity to expand off their own balance sheet I suspect they'll continue to try and do that. I think where things like equity partnerships come in is where they may be constrained, so they don't have enough to go and buy the farm that they want to buy with their own equity. So what's the next best thing to do? Find some other people to help you do that, and you've obviously got to share the costs and share the returns. So I think what's critical though is that that scale continues to build. I mean, there are a lot of subscale farms, certainly in New Zealand, and I suspect in Australia. You know, I personally would like to see family farms be able to participate in buying, you know, the smaller operators, not just the big corporates and not just the big funds. You know, I'd like to see Australian farming families being able to continue to participate in the growth of the sector. But where you run out of balance sheet capacity yourself, then you need to look for other mechanisms to bring equity to the table. And I guess, to me, the innovation needs to come around the structuring of that rather than the debt finance piece itself. As I said, too much debt can be a bit risky. So, and also, I think potentially these big investors that we've heard about, the big corporate investors, particularly the non-industry investors, those that are coming, you know, the superannuation funds, they don't know how to run farms, and I think there's a great opportunity there for really good quality farmers who've got that experience in running farms to either partner with them or work for them in terms of management of good farming enterprises. And there's a great opportunity there for larger scale farming families to take their skills, which the top 25% everyone talks about. It's not that easy to be in the top 25% of farmers. There's real skill in doing that, and I think that there's a great opportunity for those families or those farmers to look for how can I add value to somebody else and make some money and build some more of my own equity in that way. Even if those partners don't want to be equity partners with them, they sure as hell need their skill set.
I guess, did you want to say anything, Marcelo?
Any particular interest in the case of Brazil? Because this is such a huge problem in Brazil in terms of indebtedness of farmers that it will take us another meeting to discuss it here. But this is also a problem in Brazil, and it comes from the time of the economic plans that caused a lot of indebtedness in the farm sector that was called upon the responsibility of some of this indebtedness in the past, that due to that interest rates that were very high in the past, even for the agricultural sector, it has been rolled on and on and on and on, and maybe
never crystallised.
Yeah, this is a very serious problem that we'll have to take on within the next years, because it's just not a huge problem nowadays because of this. Many of these legal authorizations have been authorized farmers to keep on farming in spite of their debts. They are being victorious in the judicial system, but in a foreseeable future, we'll have to tackle this problem that is very serious in Brazil.
I'm interested, and I guess part of the question there probably relates to the fact that in both Brazil and New Zealand, agriculture is such an important part of the economy that perhaps it gains significant attention from the finance sector. Whereas, Michael, the difference might be that in Australia, agriculture is almost regarded as a fringe sector. Is that your experience? I know ANZ wouldn't claim that at all, but I mean, more generally speaking, in speaking to the finance sector, agriculture is not regarded as part of the mainstream in some regards, is it?
Let me dare to speak on behalf of my colleagues from the other banks in the room and totally disagree with you, Mick. And I think, look, Rabo, for example, and I used to be one of them until I shared the orange shirt, prides itself on particularly having agri-focus, but the other four as well, I think in many ways continue to beef up, well, it's interesting, beef up their agri sides, they keep that consistent farm gate side, but what the other four big banks have all changed over time is their sophistication into the processing and to the value chain side. And that sophistication, I'd say, is the same across all four at the moment too, into how to now restructure, particularly the infrastructure side, whether it's irrigation, whether it's transport, into new kind of structures that can access the financing that government is not going to provide for it anymore. So the banks are now seeing that opportunity. The industry needs that opportunity. Government needs that. So I think that's where the new developments are coming.
So Basel III is not going to result in any rationing of credit for agriculture?
Mick, it's 1:10 and you want us to go into Basel III?
Sorry. We'll take one more question, David Palmer, and then I notice we are well into lunch, so we will...
Sorry,
call
thanks,
it quits
Mick. My question is to Ben. 35% of New Zealand dairy into equity partners is not an inconsiderable number. With your experience in the spread of Rabo, do you see a similar model extending into Australia and not just in dairy?
So 35% was the share milkers. Equity partners are often landowners who may well employ share milkers, but the point's the same. I mean, is it a viable model? Look, it's hard for me to comment. I don't know the Australian dairy industry nearly as well. You need people who are willing to who want to take those who want to take that journey, who want to start out with very little. And some of the biggest dairy farmers in New Zealand started as share milkers, and they start out with nothing, and they build. They buy 100 cows and 200 cows, work for someone else. So I think the model can work fine. There's no reason that can't work in Australia as well as it has in New Zealand. The question is, have you got the people coming through the industry who want to do that, who want to build up their equity over time, and does the industry provide the same sort of supporting mechanisms to enable that to happen? So often share milkers for a period, especially if they're just getting started, they might get a guarantee from the landowner. Well, the landowner wants his cows, he wants his land milked by a good share milker. He might offer a guarantee to the bank on behalf of the share milker to buy those shares if the share milker hasn't got enough equity. So the question is, is the industry prepared to provide some support for those people to move their way through the system, acknowledging that at some point they're going to want to, move into something bigger and better. And that's where I think the New Zealand industry has done that really well. And I can't judge as to whether the Australian dairy industry at both the industry level and the individual farmer level is sort of willing to provide the same support, because it can't just happen on its own. It needs some support, and that's what's worked well in New Zealand.